we're going to start a conversation by talking about the Wednesday Fed Chair meeting conference called by Jeremy Powell, and the three takeaways from his speech was that the interest rate is going to stay near zero for the next couple of years, and I would like to figure out what that means for different stratas of the society. And he says that by the index that he was looking at, long-term inflation, it's steady, but the short-term inflation rate is still below 2% target, regardless of the treasury bonds that they were buying massively since March 15th, I believe. So so Qiao, what do you think of the Fed's action since the market crash in March 12th? And how do you compare that to, is this a comparable model to 1930 Great Depression?
Yeah, I think it's very different from 1929 Great Depression because back in the day, they took a long time to react to the market crash and to the recession. But this time, the Fed lowered the interest rate from 1.5 to 0.5 within like 2 weeks of S&P starting crashing, and the COVID hitting the U.S. And shortly after, they announced QE infinity, which is pretty ridiculous. And over the last FOMC meeting, they announced that they're probably going to keep the rates at zero, right, for the next few years. Actually, Jay Powell said, "I'm not even thinking about raising rates," so that was pretty funny. But overall, I think this is the most aggressive Federal Reserve, the most aggressive monetary policy that we've seen so far in the history of the Federal Reserve. And overall, I think as long as you're not a like Austrian economics, like ideological fanatic, I think you would agree that the Federal Reserve has done a good job. On the other hand, by contrast, I think Congress has not done a good job of putting out fiscal policies, right? So I think on the monetary policy side, we've done a good job, but fiscal side, we've seen not much. Like we've not done enough.
Can you explain what is fiscal policy? Because I saw a video explaining we have like an alternation every 45 years. First 45 years is fiscal policy application, and then alternating into monetary policy. Seems like the first one was for like social. How do I say that?
Monetary policy is basically
distribution,
manipulating the supply of money and interest rate. I mean, supply, money, and interest rate have a very strong relationship with each other. If you increase the interest rate, you could decrease the supply of money. You can also increase the supply of money by buying directly the so-called treasury bonds and mortgage-backed securities, and that's what people call QE, quantitative easing. So that's monetary policy. Fiscal policy is generally done by the so-called like politicians. They could give money directly to households, to corporates. They could manipulate the tax rate, but generally the difference between the two is manipulating the supply money versus pretty much everything else.
It's more about Congress is more about distribution. Monetary policy.
Well, traditionally it's more taxes, right? You would generally decrease taxes if you want to increase the aggregate demand in the economy. That's how it worked traditionally. But this year, Congress, by historical standard, they're pretty aggressive. They are giving money directly to households and small businesses. So that's what people call helicopter money. Okay. But we're probably going to see even more of that in the near future. In fact, what we're probably going to see is what people call modern monetary policy, modern monetary theory, MMT, which is like a mix of, or I should say, merging the monetary policy and fiscal policy. So basically, the Fed would increase money, print money, and give it directly to Congress, and Congress will give it to the households and small businesses.
Okay. Wait, you were saying Congress wasn't doing enough in this case, but they were giving out 1,200 check to low-income people, I think, and the PPE program. So you're criticizing those two?
So I think in total they've done $2 trillion worth of fiscal policy, helicopter money. But the thing is, this was the worst recession since the World War II. $2 trillion is not enough. It barely fills in the holes, but it does not stimulate any demand, right? So there's no. Yep, go ahead.
So let's talk about how real is its relation, like COVID. I think COVID is just closing the economic activities, but the issue is already there, piling up with the long-term debt issue goes into a debt crisis. But why does Jerome Powell not addressing that and saying that our economy is doing good? And it's not related to the Great Depression, but you look at the model, it's similar, no?
Yeah, I mean, central bankers and politicians, they pay lip service. Like they have to, present themselves as, being optimistic about the economy and doing a good job. But the reality is the recession started before COVID. COVID basically only accelerated the recession. The world trade, I think, started decreasing in late 2018. Leading, economic indicators like PMI, they started deteriorating way before COVID. To your point, the general debt levels in the economy is quite high. Corporations are highly leveraged. Households are okay, but generally speaking, there was a lot of risk before COVID, and the COVID basically accelerated the recession.
So what happened in 2018 that started to slow down the world trade?
We don't know. I mean, like macroeconomics is a very complex system. We don't know what caused it. I mean, you could argue that there's the trade war issue between U.S. and China. But overall, it's very hard to say what led to the recession. Like economic cycles are always an accumulation of various interrelated events. You don't know what was the catalyst, but what you do know is that shutting down the entire country accelerated the recession.
I want to talk about two things from here, though. One is the debt per GDP ratio. That's the index that people look at for debt crisis. And the other thing, like that talk has been going on before COVID in the crypto field. And then another thing I want to talk about is I was looking at a Ray Dalio book about debt cycles. You read it. After dollar liquidity issue spread out in the world, it wasn't America who got hit the hardest. It's Central Europe and Germany became the epicenter, because they use US dollar as like reserve currency at the time. I don't know if I was accurate on that, or I remember. I could be wrong remembering. So does this happen? Is this still the case going forward? What will we see geopolitically?
So this is a good question. As long as the U.S. Still has the world reserve currency, which is the US dollar, the US will always have the so-called exorbitant privilege. So every time a recession hits, the US is probably the safest country economically because they can always print more money. And unlike emerging markets and countries that don't have a reserve currency, printing money in the US or printing US dollar does not lead to inflation, because printing money is basically increasing the supply of money, right? But as long as the demand keeps up, with increasing supply, there is no inflation. There's no depreciation of money. And the thing that happens during recession is everyone in the world wants the US dollar when a recession hits for a variety of reasons. One is, the US dollar is perceived as being the most, the safest currency. It's sort of a virtuous circle. But another important reason is world trade is actually settling in the US dollar. So people need the US dollar to pay bills, right? Even if you're not in the US. So every time a recession
companies, when they do external trade, how do you call it, import-export trade, they need US dollars to settle.
Exactly. Exactly. So so there will always be demand for the US dollar. In fact, there is more demand for the US dollar when the economy is not in a good shape. So what happens is the increase in demand offsets the increase in supply. And therefore, there is no really any inflation in terms of US dollar. So what's really happening is when the Federal Reserve prints money, you could argue that the Federal Reserve is exporting inflation to the rest of the world. And the money that they print are given to US nationals. So that's what people call exorbitant privilege. And that's why the US is always the safest country economically, as long as the US dollar is the world reserve currency. But the problem with, back to your point about Fidelio, right? The problem is if you print too much money, in the short term, you're fine, the country is fine. But in the long run, over the course of several decades, people have less and less confidence in your currency. So in the long run, if you keep doing this money printing and you don't tighten your balance sheet when good times come, what's going to happen is you're going to lose the reserve currency status. And that's probably what's going to happen in the next few decades with the US dollar.
Okay, let's talk about stock buybacks. So first of all, like stock market crashed the next day after the conference. I don't know if it's related, probably not. But the Dow is down 1,000 points. You said no, like around 5%. Bitcoin is down about 8%. It's the second largest crash since March. Is there any insight on this?
Frankly, I don't think it was because of the Federal Reserve, like whatever Jay Powell said, because the market could have reacted immediately, right? Instead of waiting overnight. I think there are a couple reasons. Just to be clear, we're talking about the crash maybe last week, end of last week, right? Like Thursday, Friday, right?
Yeah, the last one.
I think there are a couple reasons. Number one is we went too high too fast right before. There was a lot of speculation from retail Robinhoodies for a couple months before that. Right,
like everyone started. I don't understand that Robinhood part. I saw people talking about it.
Yeah, so number one, Robinhood is a trading app. It's like a broker, but it's a really nice app. It's absolutely made for degen gamblers. They have some really fancy color schemes. It gives you adrenaline rush when you make money. It's a really good trading app. And the stock market has been going up for a couple months before, right? And basically retail traders FOMO'd in. Plus they got a lot of money from Congress, right? Like the $600 unemployment and the PPE, whatever rescue package they got from Congress, right? So they have a lot of money and they don't know where to spend it, so they opened a Robinhood account and they started trading. And all they know is buying cheap stocks. So they bought HTZ, Hertz, which is a company that filed for bankruptcy, which is absolutely ridiculous. They pushed the fair price to 4 times the fair value hertz. So the stock market has been going up way too fast, right? I think the S&P 500 went all the way to 3,200. So that's one reason. Another reason is, the Federal Reserve kind of decelerated their money printing, so they printed less than they did in March. Okay, so there's less liquidity in the market, and generally speaking, that's not good. That's bearish for the market as well. But that has been going on for maybe a few weeks already. And number three is an increase in COVID numbers, right? So many U.S. states reopened, and they started reopening in April. Before April, I think the numbers, like the curve has been basically flattened. Like the curve was flattening, but as soon as they reopened, we saw a increase in COVID numbers in California, Texas, Florida, etc. So the market was kind of spooked by that. So a combination of these three events, I think, might have caused the crash last Thursday. It was a 5 to 10% crash.
Okay, so let's talk about what's pumping the stock market. It sounds like the rich people are doing it by stock buybacks, and then low-income people are doing it with helicopter money, and stock is being the only thing that's moving up in this environment. And then let's tie it back to whether you think there's definitely a correlation between Bitcoin and the stock market. That question I will give to Leo. Okay, so let's talk about stock buybacks and how stock market, the Wall Street is separating from Main Street, and how stock is not representing the economy, and how do you justify that? Yeah.
So there are a lot of arguments on both sides for and against buybacks. But in general, so number one, what buybacks are is that the corporate, corporation, when corporation makes profit, they have basically three choices. They can reinvest the profit. They can hire more people, do R&D, invest in new, business lines. Number two, they can distribute the profit as dividends to their shareholders. And number three, they can use the money to buy back their shares. So that's share buyback. Okay, so they have these three choices, but a lot of corporations they chose number three over the last 10 years. One reason, ideally when the economy goes well and there are plenty of opportunities, the corporation should choose number one, which is to reinvest the profit into new business lines. But for whatever reason, the economy has not been doing that well. So they didn't find a lot of opportunities. So they spend most of their profit in share buyback. So an interesting stat is, so if you look at all the sources of stock buying, people who bought stocks over the last decade, if you compare, foreign corporations, pension funds, individual investors, and corporate buyback. So these are different sources of stock buying. Okay, it turns out that corporate buyback was responsible for like nearly 90% of all the stock buying inflow over the last decade. So for sure, stock buyback is a major source, is the single most important reason why the S&P has been going up. Now, I don't really necessarily have a problem with it, because if you can reinvest your profit, then you have two choices. As I mentioned, you can buy back your shares, or you can distribute it as dividends to your shareholders. At the end of the day, I think it's like they achieve the same thing, right? At the end of the day, from a shareholder's point of view, whether you get dividends or if your shares increase in value, it doesn't really make a huge difference. And in fact, there is some tax benefit as a shareholder, right? Because when you receive dividends, you have to pay taxes on your earned dividend. But when your shares increase in value, you only pay dividend when you sell your shares. So you could argue that the share buyback has some benefits. But overall, I think, the most important problem is that the corporations did not reinvest their profit into R&D and stuff. What they did was they redistribute their profit back to their shareholders in the form of buyback.
Yeah, I want to talk about why they don't spend enough money in R&D and how comes that there's no tech breakthrough for a very long time already. And then I read that the GDP, especially for this reason, the GDP is not going up because of tech breakthrough, it's because of stock. Is there, which one is the cost, which one is the effect?
I don't have an answer. Again, the macroeconomics is a very complex system. It's a very hard, I can give you theories, but you never really know for sure what caused it, right? One possible reason is, again, ties back to the Federal Reserve and their monetary policy, right? So over the last 10 years, the interest rate has been very low. And that caused, what we call moral hazard, whereby the corporations, they can borrow money at a very cheap cost of capital, right? So if the interest rate is 0, you can basically borrow capital for free, and there's too much capital. So what do you want? What are you going to do with the capital? Capital is unlimited over the last 10 years, but opportunities were limited. And the only thing you can do with the extra capital is to put it back in the market by buying your own shares. So that's a moral hazard that the very low manipulated interest rate has created.
Leo, do you think this is comparable to crypto field after 2017? So much unlimited capitals, and then they don't know how to invest that.
Yeah, so I think the 2017 ICO frenzy was part of it's just a byproduct of the macroeconomic environment. And to Qiao's point, actually, at that time, right, because we didn't really see that much real technological breakthrough. And I think every time a real technological breakthrough that creates a foundation for a lot of other commerces or newcomers to build upon it, these type of progresses takes a long time and require a lot of fundamental computing paradigm to really shift, right? So I think the whole blockchain narrative that took off in 2016, 2017 was part of the an unreal expectation that kind of paradigm shift is here. But in reality, the infrastructural stuff we're still very much in the beginning phase of building out the infrastructure for this kind of decentralized settlement system that people are expecting. So I think after several rounds of building up these kind of expectation and see them crash, we're starting to realize, oh, okay, maybe the technical breakthrough that we're seeking do not exist in this kind of shape and form. So I think generally VCs who are just chasing the next hot thing are more or less confused by what's going on. They don't really have a fundamental understanding of how this works. They don't really understand what is required for this kind of paradigm shift to happen. So they make a lot of mistakes by looking for things that mirror that traditional market. By traditional market, I mean apps or services that were successful in the beginning phase of early 2000s. So they wanted to see that kind of stuff, but on blockchain. So and that was a huge reason that expectation is off.
Okay.
And I want to add to Qiao's point earlier about the misalignment of incentive. Actually, a lot of the management of these corporations are hired guns, and these CEOs, their incentive packages are tied to the EPS performance of that quarter. So they have every incentive to pump the EPS number before the earnings. So there are desks at major banks that only do that help companies do these kind of share repurchase programs, and there are programs that allow the corporation. So because there are actually restrictions on how much the company can purchase on a daily basis, and this is just to to stop the company from manipulating their own share price. But the banks can offer this kind of structured program that basically allow the corporations to gain the 80%. So for instance, a company announces they intend to buy 1 billion worth of shares back. And there's clear restrictions on how much you can purchase on a daily basis. And this is based on a certain percentage of your daily trading volume. And banks can offer this kind of accelerated share repurchase program where basically let you exhaust 80% of the total buyback program up front. And therefore, the company gets a very nice EPS boost right away. So the management, they love this, right? Especially when the rates are low, they can just put on leverage and just go buy back shares, and they get very very nice bonus. And when they turn to the rest of the market, they see there's no real things to invest in, and they can just turn to their board. See, we tried. We looked at everything. We have these new in-house venture programs. We have the best VC that we poached from Silicon Valley, and they can't find stuff to invest. So we just have to pay ourselves.
And per your point, IBM, they had this crazy AI R&D. They spent billions of majority of their funds into researching this thing that took them decades.